In this video lesson, we'll be discussing the importance of trading with discipline. In a moment, I'll break down for you two separate trading scenarios. In scenario 1, you will see why holding on to trades past the responsible exit price is not a sound trading strategy, even though you may manage to profit on the trade. In scenario 2, you'll see just how dangerous and damaging such a strategy can be. In both scenario 1 and 2, we will compare two traders, who we will refer to as Trader A and Trader B. Trader A has a tendency of holding on to losing positions, while Trader B always does his best to adhere to his conservative exit strategy. After we break down the statistics from our two scenarios, you will see just why discipline is the key to trading. Okay, in scenario 1, we have a stock that both Trader A and Trader B buy 500 shares of at $40.55, as both see potential for the stock to appreciate to $41, which is 45 cents away from their current entry point. Now, upon entering, both traders unfortunately find themselves in a tough position as the stock is quickly going against them. Trader A chooses to recklessly hold on to the position past a reasonable exit point that would meet a sensible 3-to-1 reward to risk ratio, while Trader B gets stopped out of the position as his preset exit point of 12 cents, which is well within a minimum 3-to-1 reward to risk ratio, is triggered. Now, as the stock continues its downward trend, Trader A is still holding on to his losing position as his losses continue to grow with every downtick. The stock has now hit a level 40 cents down from the point in which he originally entered at. The good news is the stock has found a level of support and has begun to reverse trend and move back up. Trader B, noticing that the level has formed, re-enters the position at a price of $40.20 for 500 shares as the stock begins another attempt at an up move. Now, this move proves to be strong as the stock manages to reach all the way up to a price of $40.75 before once again changing trends and starting to fall back down. Trader A, just happy to be up in the trade, gladly exits the position at $40.70, feeling like the king of the world. Trader B, though, sees that same exit signal and two exits accordingly at $40.70, as the stock has reached well past his set target price. Now, let's briefly summarize what each trader did in this scenario and break down the numbers. Trader A bought 500 shares of stock at $40.55 with an original price target of $41, then decided to hold on to the losing position as the trade went against him. Trader A was at one point 40 cents out of the money in unrealized losses before the stock fortunately turned around and produced a 15-cent realized profit as he exited at $40.70. Ultimately, Trader A dodged a major bullet as he risked a substantial amount to make a very little amount. Participating in trades like this one time and time again will surely whittle away your trading accounts, as this is not a fruitful strategy. Now, Trader B, who also bought 500 shares originally at $40.55, displayed great discipline and stuck to his preset exit point of 12 cents, which did make sense since it definitely fell in line with the 3-to-1 reward to risk minimum. Trader B exited the position at $40.43 and was smart enough to continue to watch the price action of the stock to see if another opportunity presented itself, which it ultimately did as he re-entered at $40.20 once a level of support was established. Trader B then exited at $40.70 once the stock began to reverse. Trader B practiced discipline and was rewarded for it by capturing a very profitable trade with very little exposure to risk. To quickly recap on the profit and loss totals. Trader A had 500 shares for a 15-cent profit, while trader B made $190 from the trades, as he had 500 shares for a 12-cent loss and 500 shares for a 50-cent profit. So which trader played the move correctly? Obviously trader B, not only because he gained more from the trades, but more importantly because he was able to keep his risk reasonably low while also being able to maximize his opportunity for gains. Moving on to scenario 2. Let's use the same setup as we did in the previous scenario. Both traders enter 500 shares at $40.55 with the same price target of $41, which is 45 cents away. Now, just like in the previous example, the stock immediately begins to go down quickly upon entering. Trader A once again chooses to hold on to the position recklessly past reasonable exit points, while trader B stops out of the position at $40.43 with a 12-cent loss. Let's also say that just like in the previous scenario, the stock finds a level of support at $40.15. Trader B once again enters into the position at $40.20 for 500 shares and sets an exit point 2 cents behind the current level of support, which is present at $40.15. This time, the stock fails to move back up and breaks the level of support, causing trader B to once again exit, this time for a 7-cent loss. Trader A, however, still is holding on to his original losing position, hoping that the stock will go back up. The stock continues to fall to $39.75, where it once again finds a new level of support. Trader B again buys 500 shares, this time at $39.81, and places a stop loss exit 2 cents below the current support level. The stock unfortunately continues its weak trend and goes through that level of support with ease, stopping out trader B for the 3rd time. Trader A, having watched his position lose more and more money, finally has had enough and sells at the same point as trader B, $39.73. Now let's briefly summarize what each trader did in this scenario and break down the numbers. Trader A bought 500 shares of stock at $40.55 with an original price target of $41. Then decided to hold on to the losing position as the trade went against him. Unfortunately for trader A, the stock never comes back up. He ultimately gives up on the position and loses a substantial amount of money by not practicing any form of trading discipline. Now trader B, who ended up buying the stock 3 times only to get stopped out each time for losses, always stuck to the sound exit points he had set, and by doing so managed to keep his losses small. To quickly recap on the profit and loss totals. Trader A lost $410 from the trade as he held on to 500 shares for an 82-cent loss, while trader B lost a total of $135 from the trades as he had 500 shares for a 12-cent loss, 500 shares for a 7-cent loss, and 500 shares for an 8-cent loss. So which trader played the move correctly? Obviously, trader A and trader B incurred losses on their trades. However, trader B lost substantially less money compared to trader A, even though trader B was wrong 3 times on the stock. More importantly, trader B was able to keep the losses fairly small by identifying reasonable exit points that fit his 3-to-1 reward to risk ratio. Trader A, however, refused to accept the reasonable losses early and instead let his emotions dictate his trade, not the market. As shown in both scenario 1 and scenario 2, simply holding is simply hoping. Try to leave your emotions out of the trade. Flat out holding on to losing positions just because you can't accept that you're wrong is not a good strategy. In fact, it is a strategy that over time will destroy your trading account. Instead, take advantage of a sound, logical strategy that does not rely on hope. Always attempt to limit your risk as much as possible, while allowing yourself the opportunity to maximize your gains. In other words, keep your losses small and let your winners run. By utilizing a bare minimum 3-to-1 reward to risk ratio, you will have the same opportunities to maximize gains while being able to prevent reckless losses. To find consistent success in the markets, it is essential to always trade with discipline.